Do you know how inflation is silently affecting your finances in 2026? While rising prices are the obvious impact, inflation often sneaks into our daily lives in subtle ways, like shrinking product sizes and hidden fees, quietly eroding your purchasing power. Understanding how inflation works and how it affects your wealth is essential for managing your finances effectively. In this video, we'll explore the top 8 ways inflation secretly steals your money and share strategies to protect yourself from these hidden costs. Don't let inflation quietly drain your wealth. Let's dive in and learn how to safeguard your finances. 1. Shrinkflation, the package magic trick. One of the most common, yet sneaky ways inflation steals your money is through shrinkflation. This happens when the price of a product stays the same, but the quantity or net weight decreases. Manufacturers often reduce the size of the package, but keep the price intact, hoping you won't notice the difference. The real danger with shrinkflation is that it's not always obvious. Many people don't regularly track product quantities or weights, so the change often goes unnoticed. Over time, this erosion of value adds up, meaning you are paying the same price but getting less for your money. It's a direct hit to your purchasing power, and it often happens so gradually that you don't realize it until it's too late. To avoid this, always check the net weight or volume of products you regularly purchase and adjust your budget accordingly to account for the reduction in value. 2. Skimpflation, the service decline. Another inflation-related phenomenon that erodes your financial power is skimpflation. This is the decline in service quality without a corresponding decrease in price. Many businesses, especially in the hospitality and travel industries, maintain their prices but reduce the quality or quantity of services provided. The key here is that businesses know they can get away with cutting services without lowering prices, and many consumers are simply willing to accept it. To protect yourself from skimpflation, be proactive in reading reviews, checking service inclusions, and questioning whether the value you're receiving aligns with the price you're paying. 3. Bracket creep, the tax trap. Bracket creep refers to a situation where your income increases due to inflation, but you are pushed into a higher tax bracket, leaving you with less net income. This phenomenon occurs when salary increases intended to keep pace with inflation are not adjusted for the tax brackets, causing you to pay more in taxes without a corresponding increase in your real purchasing power. In 2026, bracket creep continues to affect many workers, especially as inflation pushes wages up, but tax thresholds remain static. To mitigate this, it's crucial to optimize your tax strategy, such as contributing to tax-advantaged accounts like 401(k)s or Roth IRAs. These accounts allow you to reduce taxable income, helping you offset the negative effects of bracket creep. Additionally, working with a financial planner to ensure your tax filings are as efficient as possible can help reduce the overall impact on your income. 4. The idle cash penalty. One of the most common yet overlooked ways inflation silently steals your money is by holding cash in a traditional checking account or a low-interest savings account. Inflation consistently outpaces the interest rates paid by most banks, especially in 2026 when inflation rates are high. For example, if inflation is running at 4% and your bank offers a 0.01% interest rate, you are essentially paying the bank to hold your money, losing 3.99% annually in purchasing power. This phenomenon is what some financial experts call the idle cash penalty. The money sitting idly in your checking account is slowly losing value because the interest earned is far lower than the rate of inflation. To protect yourself from the idle cash penalty, it's wise to move your cash into high-yield savings accounts, HYSAs, which offer interest rates that are significantly higher than traditional savings accounts. HYSAs allow you to preserve and grow your cash while minimizing the impact of inflation. Additionally, consider investing in short-term bonds or money market funds to generate a better return on your idle cash, ensuring that your money is working for you rather than losing value over time. 5. Subscription creep, the digital leak. One of the most insidious ways inflation drains your finances is through subscription creep. Digital subscription services like streaming platforms, apps, and software tools tend to raise their rates gradually, usually by a few dollars every 18 months. While these increases may seem small, they add up over time and can lead to a significant drain on your disposable income. Many people don't notice these small increases because they are automatic or they forget to cancel subscriptions they no longer use. Over time, this digital leak can total a considerable sum, leaving you with less money for savings or other investments. The key to avoiding subscription creep is to regularly review your subscriptions and cancel those you no longer need. There are also apps like Truebill that can help you identify and track your recurring charges. By being proactive and monitoring your subscriptions, you can protect your budget from the creeping effects of small price increases that go unnoticed. 6. The replacement cost gap. The replacement cost gap occurs when the cost to replace or repair something you own, such as a car or home, rises faster than the value assigned by your insurance policy. In 2026, the cost of materials and labor has increased significantly, and many people find themselves underinsured because their coverage hasn't kept up with these rising costs. In many cases, this gap occurs because people fail to update their policies regularly or don't factor in inflation when selecting their coverage limits. As property values rise and the cost of materials continues to increase, your insurance needs to reflect these changes to ensure that you're not left paying for the difference when it matters most. To protect yourself from the replacement cost gap, it's important to regularly review your insurance policies and ensure that your coverage reflects current market values. This is especially crucial for homeowners, as property values and construction costs are likely to continue increasing over time. Ensure that your insurance company provides enough coverage to replace or repair items at current prices, not just based on their value at the time you purchased the policy. Keeping your insurance updated will help you avoid unexpected financial strain and ensure that you're adequately protected in times of need. 7. Real estate hidden costs. While real estate may be an excellent long-term investment, inflation can still affect property owners in subtle ways. Even if you have a fixed mortgage rate, inflation drives up other costs associated with homeownership, such as property taxes and home insurance premiums. As the value of your home increases on paper, local governments often raise property taxes to reflect the new, higher home value. Similarly, insurance companies adjust your home insurance premiums based on market conditions, including rising construction and labor costs. These increases can significantly eat into your monthly cash flow, even if you're not making additional mortgage payments. To mitigate the impact of these hidden costs, it's important to regularly assess your property tax situation and shop around for better insurance rates. This can help ensure that you're not overpaying for taxes or insurance, allowing you to better manage your finances as your property appreciates. 8. The delay tax. Finally, delaying purchases for necessary goods or services is another way inflation quietly steals your money. The delay tax refers to the fact that inflation often makes prices for materials and labor rise faster than general inflation, meaning that waiting to buy something you need, whether it's a dental procedure, home repair, or a car, will cost you more over time. If you postpone buying an essential item or service, the price is likely to increase faster than your ability to save for it. The cost of specialized labor and materials tends to rise quickly, often outpacing general inflation rates. In many cases, waiting to save up for a major purchase ends up costing you more as prices continue to climb. To avoid the delay tax, it's crucial to prioritize necessary purchases and avoid procrastinating on essential items. While it's important to save and budget for big-ticket items, timely action can often save you money in the long run. There you have it. The top 8 ways inflation secretly steals your money in 2026. From shrinkflation to hidden costs in real estate, understanding how inflation affects your finances is key to protecting your wealth. If you found this video helpful, don't forget to like, share, and subscribe for more tips on how to stay ahead of inflation and build long-term financial stability. Let me know in the comments which inflation trap surprised you the most and how you plan to fight back. Thanks for watching, and I'll see you in the next video.